Cool.
Okay. Can I? Okay. Do you see on the right-hand side the Zoom box or not? Is it just me?
No, it's no worries. Everyone can adopt their screen as they would like.
Very good. Okay, so hello to everyone from my side. My name is Anu Kalmurand. I have been a mentor in Prototron for, I think, over 5 years now. I've also taken part in the expert committee even one time. So I have seen quite a lot of different Prototron participants, and every year there's something interesting and new. So it's very awesome to be part of this project. So today, what I'm going to tell you about is mainly about one way how you can finance your business. So all of you probably are trying to become entrepreneurs if you're not already. So if you're an entrepreneur, there are quite a few different ways how you can finance your investments, and financing it with a bank loan is one of the options. So my name is Anu Kalmurand. I work in Swedbank. I've been working there for 7 years. And during these 7 years, I've dealt with financing corporates, basically. So usually the companies that I deal with are large corporates. So usually their revenue is over 20 million euros, and loans that they apply for usually over 3 million euros. Then they will come to my table, but hopefully all of you will become one day also such big companies, and perhaps in a couple of years we have the pleasure to meet. Okay, so my first slide is about the company life cycle. I just wanted to show you, it's quite an interesting slide, quite theoretical, how usually a company's kind of life cycle through time evolves, and during these different life cycle moments, it's also kind of different financing options that would be useful to have. For example, bank financing usually is not the right way of financing in the very beginning of the company's life cycle, just because usually when banks give out their loans, they already want to see quite a stable business. They want to see stable cash flow. They want to be sure that the company is able to generate this cash flow for a long period of time in order to pay back the loan, basically. So in the beginning of the company life cycle, where usually you have to invest quite a lot to get the revenue going and to get the profits going, there are different and better ways to finance your business. The logic behind it is that if a bank gives a loan, then it has a set start and set ending date. It has a quite definite paying back schedule. Whereas if you raise money from venture capital funds, for example, then they are much more flexible regarding how much time they are willing to be in the company or get their money back. And they are also have a much larger risk appetite. So as you know, banks, they want to have collaterals, they want to see profits, whereas venture capital funds, they don't need collaterals and they are much more flexible. That's definitely their strength. So I already mentioned a couple of financing options, but usually if you start with a company, if it's a startup, it usually means that you have to invest quite a lot in order to get your idea going. So some financing options, definitely friends, family, and fools, they call it 3F. This is usually one of the first financing options that startups use. Also, angel investors. Definitely, you can get some some good like mentoring from angel investors. There's also crowdfunding, venture capital funds. There are also like private equity funds. However, compared to the previous financing options that I talked about, private equity funds usually also they kind of specialize in more mature companies. So usually when the company is just a startup startup phase, then usually they would like to see the company to mature a bit more before they are willing to put in the money. So banks and private equity funds, in that sense, are usually quite similar in a sense when they are ready to finance the business. There are also other funds, mutual funds, pension funds, and of course, one of the options is also to have an initial public offering, so be listed on a stock exchange, but this is also for mature companies, usually. Okay, so now I'm going to tell you a little bit about the bank's view. So how we analyze loan projects. I'm going to educate you a little bit on what the banks look at when they are financing the companies. This is just an introductory slide where you can see how much money banks have given out as loans. It includes all Estonian banks, and as you can see, the total investment by the banks has been quite stable over the years. And actually, one of the things that is very, how do I say, like not different, but like Baltic markets do rely quite heavily on bank financing, much more so than the rest of Europe. So banks are definitely very, very important organizations in order to kind of keep the economies in the Baltics going. So yeah, for mature companies, banks are usually the first option for investments. Okay, so in order to be applicable for a loan, what kind of materials you should send to the bank, what we usually ask for. So we will ask definitely the last year's annual financials in order to analyze them, to see how stable the financials have been, to kind of understand the risks associated with the project. We also ask definitely the year-to-date financials in order to see what's the latest status of the company, also to compare it with the previous years to see how the trend is going. Are the profitability margins stable? Is the revenue growing? What's the trend there? Then we definitely need to have explanation of the business plan. So the bank has to understand how the company is generating their profits, in order also to understand the risks associated with the operations, to make a knowledgeable decision on whether or not or how to finance the company. Banks also need collateral. It can be a house, it can be mortgage, it can be commercial pledge, which is basically all your current assets except for cash. There are also different surety options available. For example, in Estonia, we have Kredex, who gives surety to the banks in case there's a company who wants a loan, but they don't have very good collaterals to offer. Yeah, and then reasonable financial ratios. I will talk in detail about this in the coming slides, what is reasonable from the bank's view. And definitely we will conduct a very thorough risk analysis. The risk analysis doesn't only include credit risk, which means basically understanding what's the probability of the company going into default, what are the operational and financial risks, but also anti-money laundering risk. So in order to understand our potential clients' risk, we also have to understand the client's risk. So to whom the company is selling to, from whom he's buying stuff. So we kind of have to understand what kind of counterparties the company has, and whether these counterparties are acceptable from anti-money laundering risk perspective. Okay, so I promised you some numbers, and here they are. I'm going to swiftly go through all of these numbers, but if you're still not sure about my explanation, then there's this very good website. It's called Investopedia. It's like encyclopedia for investment terms. So if you want to kind of read more on some of these ratios, then I definitely recommend going on that page and so-called Googling it. In order to be bankable, what you have to have, definitely positive historical EBITDA. EBITDA is a proxy for cash flow. So positive EBITDA means you have positive cash flow coming in month on month, year on year. Negative EBITDA means you are having a negative cash flow. So rather you're perhaps in a startup phase, you are kind of financed from investors who finance your negative cash flow. But in order to be applicable for bank loan, you should have a positive cash flow from which you will then pay back the loan. Also, we look at capital expenditure, or in other words, investment needs, meaning that even if we see that your EBITDA, which is basically operational cash flow, is positive, but if you require quite extensive capex, so this can actually cause your cash flow to become negative. But in order to pay back the loan, you have to have a positive cash flow even after considering all the investments that you need to have. What we also look at is liquidity. This can be analyzed through, for example, current ratio, which is basically current assets divided by current liabilities. Usually it should be over 1.1. It just shows that you have enough current assets, which are basically quite liquid assets, to kind of pay back your current liabilities, which are liabilities that you have to pay back in the next 12 months. So it's quite a short-term view. We also look at equity ratio. Usually it should be over 20%. It just shows that the company has kind of equity buffer, that their balance sheet is strong enough to take on bank loan in case there is some kind of stress situation, and for example, net income is negative, then negative net income basically makes equity go lower. So it just shows that you have enough equity so that in case of negative net income for some period of time, you still have some equity buffer. Then also debt EBITDA is probably one of the most important ratios that all banks analyze. It just basically shows in how many years you are able to pay back your debt from your cash flow, from your operational cash flow. We usually would like it to be below 5. I would even say below 4. There is this exception for real estate loans, because real estate loans, their payback period is usually longer, 10 to 12 years even. So then this EBITDA can be higher. But otherwise, for investment loans to the industrial companies, for example, or some acquisition loans, usually the loan should be paid back in 5 years on average. It of course depends on the company. So that's from where this ratio kind of comes from. Then DSCR, it's a debt service coverage ratio. It's basically your EBITDA, which is your cash flow, operational cash flow, divided by your monthly debt payments. So if it's over 1, it means that your operational cash flow is exactly the same as your, for example, annual debt payments. So why we want it to be more than 1.1 is at least more than 1.1 is to have a little buffer there. So in case your operational cash flow, your profitability drops a little bit, you would still be able to service your obligations. Okay, then we move on to collaterals. There are quite a few different collaterals that companies use when they take the loan. Mortgage, I think, is the most usual one. It just means that you have some kind of real estate to give as collateral. It can be an industrial complex. It can be an office building. It can be a storage unit. It can be many things. Then we have commercial pledge that I mentioned briefly before. Under commercial pledge, there are all kind of, for example, your stock can be under commercial pledge. There can be some equipment that you have, for example, in case of industrial companies. So commercial pledge is quite a wide, there can be quite a wide range of different items under that. Then we also have personal surety. This is very usual in case smaller companies want to have a bank loan. So we actually also have a possibility to give kind of startup loans, and there I think one of the collaterals that we would ask for is a personal surety. Then there are also credits, so basically Estonian government surety. It costs usually from 1 to 4%. So it's an additional cost for the company who takes the loan, and Credit usually gives up to 80% of loan amount and up to 5 million euros per company. And then there's also this MES, which is rural development agency, basically, who also gives their sureties. So Credit and MES sureties are usually used in case the company is, for example, a service provider, so they don't have some kind of real estate or equipment to give to us as a collateral. And so we have kind of talked about all these financial requirements. There also is a need for finding collateral to the bank, so it might all seem quite overwhelming. Like why would anyone use a bank loan? It's quite complicated, but actually bank loans are generally really affordable. You don't have to give away any equity in order to get financing, and it's usually also quite quick. If you want to raise money from investors, for example, it can take 6 months to a year or even several years. If you have a solid company with solid cash flow, you have some collaterals, then from a bank you can get a positive loan decision in a matter of weeks. So it's actually quite accessible and quick way of financing a company. And also what the bank loan does, it helps businesses to increase their return on equity, because you don't have to kind of raise equity to do your investments. Rather, you pay quite a small fee in terms of interest, and all the rest kind of positive cash flow that is generated from this investment, it remains as a profit that can be then returned to the shareholders. Okay, so I already talked about kind of financial requirements and collaterals, and what the banks usually do is when a company turns to us with a loan project, we analyze it, we put together a term sheet. So the term sheet is basically a piece of paper with indicative terms, in addition to the loan amount and the interest rate and the schedule in how many years the loan should be paid back. It very often also includes financial covenants. Financial covenants mean that kind of we will put these covenant numbers or caps into our loan agreement, and the bank expects the company to fulfill them, and we will calculate them on an annual basis or on a quarterly basis, just to make sure that the company is adhering to these terms that we kind of agreed upon during the loan. This also kind of helps the bank to manage their risks. So in case during the term of the loan, usually 5 years, in case there are some stress situations and the company's profitability, for example, goes down a lot, like we have today, for example, in this Corona crisis, a lot of companies do suffer, at least in the short term, then we have the opportunity to kind of come together again with the company and discuss, okay, your profitability has decreased. What should we do? Should we give a grace period, which means that the company will still pay the interest rate, but not the main amount of the loan sum? So should we give a grace period, or should we prolong the loan so that each monthly payment would be smaller, which would be kind of easier for the company to service? And of course, today, when we are giving out these grace periods, then we do not do anything to the margins. Usually, we don't even take any fee. We are all in this situation together. But in case the economy is doing good, but the company is struggling, then the bank has the opportunity to kind of revise also, for example, the interest rate, in case the company's risks have increased, for example, and they are not fulfilling the financial covenants that were agreed upon when we gave out the loan. In addition to these financial covenants, which are usually kind of some capped numbers, we also have some other special conditions we very often put into the loan contract. Some of them are, for example, negative pledge, which means that the company cannot pledge its assets to other parties. Also, we have cross default, which means that, for example, there are very often, it's not just one company who's taking the loan. It's very often, if it's a big corporation, there are several companies that kind of contain in one group. And we are very often in these group companies, in all of them, with some kind of loan or overdraft or whatever product. Then cross default means that in case one company or one contract is in, let's say, default, then we have the opportunity to also revise all the other contracts we have within the group. Then we also often put kind of prohibit the company to take additional borrowings, just because at the point when we give out the loan, we analyze the company, we see, okay, they have such many debts and their operational cash flow is like that. So we kind of analyze the risk. If they take on more and more loans, then obviously the risk becomes higher and higher. So this is also one of the conditions that is very usual for the banks to put in a contract. And also no change of ownership, maximum investments. It's not that all of these are always in all of our loan agreements, but these are some of the examples from where we then pick which is the most important for us to have. We are also sometimes cap dividends in order to make sure that the equity would keep on growing on a steady base, further kind of decreasing the credit risk. Okay, so I have a little case study for you as well, just to kind of show you how we analyze the companies when we look at the financials, what kind of patterns we are looking for. So for example, we definitely look at the revenue. We kind of analyze what's the trend there. For example, in this case, we see that in 2017, the revenue increased by 26%, and not just look at the financials and calculate the growth. We also want to see and understand why numbers move as they do. So this is very important part of our analysis. It's not just clients sending us a package, we analyzing it and then making a decision, but it's more of a back and forth communication. So the client sends us the package, we review it. We obviously have some questions why things look the way they do. We kind of ask the questions to make sure that we really understand what is going on in the company. And you can also see, for example, even though that in 2017 the revenue grew, the gross profit actually decreased compared to the year before. So obviously the gross profit margin, so gross profit divided by total revenue, decreased quite substantially. So that's another thing that we ask, like, why did your gross profit margin decrease? What kind of extra expenses you had to make in 2017? Are these expenses something that we can assume we will also have to do in 2018 and going forward, or they're just some one-off expenses? So in case we look at the forecast, for example, we can deduct these expenses, one-off expenses that were done in this year that kind of drew down the profitability. So yeah, we definitely want to understand why revenue is growing, why profit margins fluctuate if they do, what kind of costs the company has to bear, what are the fixed costs that they definitely have to pay month on month, what are the variable costs that they can actually scale back on if there's a stress situation like we have today, for example. Yes. And then here you cannot see this earnings before interest, tax, depreciation, amortization, which is called EBITDA. But basically how it can be calculated from here is taking the operating income and adding the depreciation, because depreciation, it's a cost line in your income statement, but actually it's not the monetary cost. Depreciation is just you have done your investment at some year, and then you deduct this investment on your income statement every year, a small amount, but actually you have already done this expense, and it's just a kind of non-monetary item. And here's an example of a balance sheet. What we look at when we analyze a balance sheet, we definitely look at the cash, which is the liquidity buffer of the company. In today's world where we have this corona crisis, companies that are really affected by it, we see that companies who have enough cash on their account, they are in a much better position to support their company through this crisis, whereas companies who have invested all of their cash or paid it out as dividends and they don't have this buffer, they are quite struggling right now. So they have to really cut costs, find extra financing from banks or from investors. So definitely it's a good idea to keep a buffer just in case. What we also analyze, for example, are receivables. So accounts receivables. If we see that year on year the receivables amount is growing more than revenue, for example, then it's kind of a red flag. It might show that the company has troubles negotiating with their clients regarding the payment term, for example. Their clients perhaps require longer and longer payment terms, which then results in a higher and higher receivables. Or maybe there are problems with actually getting paid from their clients. So maybe they have overdues. So then we would definitely ask more information on that. For example, do you have any overdues? Do you have any overdues that are more than 30 or 60 days? Then we also analyze inventory. So something that can be used to manipulate finances. There's also inventory in case you have, for example, an industrial company and they are producing something in their factory, then there's this possibility basically to produce a lot, even though you're not selling all of it. You just produce it a lot so that your cost per unit is quite small. And on the income statement, you can see that, okay, I have X amount of revenue, cost per unit is quite small, under the line is quite a nice profit. But then if you look at the balance sheet, you can see that because they are not selling what they are producing, their inventory is going up and up and up. Their cash is going down because it's all tied into the inventory. That can be a red flag as well to kind of look out for, because you cannot continue with the strategy for a long period of time. You will run out of cash, you'll have all this inventory, you will have nothing to do with it. Maybe it's inventory that's last season goods. So that's something that we definitely look at. Then also often there are such items as goodwill and intangible assets on the balance sheet. These are assets that are not tangible, meaning they are not, you cannot kind of touch it. It's not an equipment, it's not real estate. It's, for example, your company value, your brand value. If you've bought some companies and you paid extra for it, for example, their future growth, their future cash flow, then this is also included in this goodwill. And then on the other side of the balance sheet, where we have equity and liabilities, we look at how much debt the company already has, what are their kind of equity ratios, to understand kind of, okay, they have all these assets, how they have financed these assets, how much debt have they raised, how much equity have they. So yeah, this also shows kind of the risk profile of the company. The more equity they have, the lower the risk. The more debt they have, the higher the risk. Okay, this is it from my side. Perhaps you have any questions to me.
Thank you.